Index funds, the strategy that consistently beats most professional fund managers. By the end of this tutorial, you'll understand why this works structurally, not just statistically, and how to build the minimum viable implementation. What is an index fund? An index fund holds all the securities in a market index, in the same proportions as the index. It is market cap weighted. Larger companies have larger positions. The fund manager does not select individual stocks. The portfolio changes only when the index composition changes. The most commonly used indices. The S&P 500 tracks 500 large U.S. companies. The FTSE All-World tracks thousands of companies across dozens of countries. MSCI World covers developed market equities. Each can be tracked by an index fund at minimal cost. The fee comparison. Major global index funds charge 0.03% to 0.2% per year in management fees. Typical actively managed funds charge 0.75% to 1.5% or more per year. This gap doesn't sound dramatic, but over decades of compounding, it becomes the single most important factor in the outcome. Here is the compounding fee impact in concrete numbers. £500 per month invested for 30 years, assuming a 7% annual return. With a 0.1% expense ratio, typical for a low-cost index fund, the outcome is approximately £580,000. With a 1.2% expense ratio, typical for an active fund, the outcome is approximately £500,000. The difference of around £80,000 is entirely attributable to fees, before considering whether the active manager beat or underperformed the market. The SPIVA report, published twice a year by S&P Dow Jones Indices, is the most comprehensive ongoing comparison of active versus passive fund performance. The consistent finding, over a 15-year period, approximately 85 to 90% of actively managed large-cap funds underperformed their benchmark index after fees. This is not a period-specific finding. It holds across most time periods and most market categories. Why does this happen? The structural arithmetic. The aggregate of all active fund managers' performance must equal the market return before fees. Every security bought by one active manager is sold by another. In aggregate, active managers are the market. They cannot collectively beat the market before fees, and after fees, they must lose to it. This is the zero-sum problem. For every active manager who outperforms the market, another active manager must underperform by an equivalent amount. The index fund investor sits outside this competition. They capture the full market return minus minimal fees. The active fund investor pays fees to compete in a game that, in aggregate, cannot produce a positive outcome after costs. Additional structural drags on active fund performance. Transaction costs from frequent buying and selling reduce net returns. Capital gains events from those trades create tax liabilities in taxable accounts. Very large funds face a constraint called market impact. Taking a meaningful position in a smaller company moves the price against you. Where active management has a theoretical edge. Markets in small-cap stocks, emerging markets, and illiquid asset classes are less efficiently priced. Fewer analysts cover these areas. Information advantages are more achievable. A skilled analyst has more potential to find genuinely mispriced securities in these less followed segments than in heavily covered large-cap markets. However, even in these less efficient markets, the majority of active funds still underperform their benchmarks after fees over long time horizons. The theoretical potential is real. The practical track record is still weak. A small number of managers do consistently outperform even over long periods. The problem is identifying them in advance before their outperformance occurs. The minimum viable strategy. Choose one low-cost global all-world index fund. Set up automatic monthly contributions. Reinvest dividends automatically. Do not make adjustments based on market news, economic commentary, or recent fund performance. That's the entire system. The three-fund portfolio is a slightly more structured version. A global equity index fund. A domestic market equity index fund for potential tax efficiency on home country dividends. A global bond index fund to reduce volatility as you approach retirement. One annual check to see if the allocation has drifted and needs rebalancing. This is the full system. The critical variables are three. Savings rate. How much you contribute each month matters more than any investment decision. Fee minimization. Keeping expense ratios below 0.2% over decades compounds into thousands of pounds. Time horizon. Starting earlier is the single highest leverage decision. Market timing, fund selection, and tactical allocation are not the critical variables. Dollar cost averaging is a natural feature of regular monthly contributions. When you invest the same pound amount monthly, you automatically buy more units when prices are low and fewer units when prices are high. This removes the timing decision entirely and ensures you benefit from market volatility rather than trying to navigate it. The time horizon impact is difficult to overstate. An investor who starts contributing at 25 versus 35 with identical monthly contributions will in expectation accumulate roughly double the outcome by retirement. The first decade of contributions has compounding time that the later decade cannot replicate. Starting is the most important decision. The behavioral challenge is the hardest part. Index fund investors will experience drawdowns of 30 to 50% in severe market downturns. The 2008 to 2009 financial crisis, the 2020 COVID crash, and multiple other episodes produced drawdowns of this magnitude in global equity indices. Holding through these periods, not selling, not switching strategies, is the action required to capture the long-run return. Why investors switch at the wrong time? Recency bias causes investors to extrapolate recent losses forward. Loss aversion makes a 30% decline feel much worse than a 30% gain feels good. Active fund managers have strong incentives to market themselves during volatility, promising protection that their track record often doesn't support. The combination is dangerous. Switching from a passive strategy to an active one during a drawdown locks in losses and typically misses the recovery. Tax considerations favor index funds and taxable accounts. Index funds trade infrequently. Portfolio changes happen only when index composition changes. Active funds trade frequently. Every trade in a taxable account is potentially a capital gains event. Over decades, the tax drag from frequent active trading compounds into a significant additional return reduction on top of the management fee disadvantage. Summary: simple beats complex in investing when simple means low cost, diversified, and consistently held. Low cost beats high cost because fees compound over decades. Consistency beats timing because market timing reduces returns and increases stress. The minimum viable strategy: one global index fund, automatic monthly contributions, long time horizon, is what decades of data supports. Full breakdown at realsyllabus.com.